banks, credit unions, insurance companies would wither up and die if they did not borrow money and pay interest. In this educational episode, I'm going to teach you that there is such a thing as good debt. Get ready. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for nearly 5 decades. And I've been very honored during my career to have authored, thus far, 12 best-selling books. And in all of my books, I talk about this concept of how money works. And I have empowered thousands of people since the mid-1970s to become their own banker, so to speak. It's called the banking concept, and it's not new. It didn't originate with me 50 years ago. It's actually been in the Bible for centuries. There are a lot of financial advisors who use this banking concept and call it one thing or another. Nelson Nash, for years, called it infinite banking. And in 2008, the year after I talked about it in my third book and had a chapter that said, Learn How to Become Your Own Banker, he came out with a book titled Becoming Your Own Banker. A year after that, I believe, is when Pamela Yellen came out with her book, Bank on Yourself. Now, Pamela has asked me to make sure it's clear in my YouTube episodes that I am not affiliated with Bank on Yourself, nor with Nelson Nash, and they do not sponsor me. In fact, I do not endorse them, but the concept has been around for centuries. And so it's basically how to make money work for you and why it's wise sometimes to pay interest in order to make more interest. And so that's why I say there's 3 kinds of people in the world: those who pay interest, those who earn interest, but the mega wealthy thrivers learn when it's wise to pay interest in order to make more interest. In this episode, let's talk about good debt versus bad debt, because a lot of people have a goal to get out of debt. Now, that's a good goal, but sometimes they define out of debt as not owing anything. Well, I have learned that there are smart and quick ways to get out of debt, and it could be where you do a biweekly payment plan and you magically get your mortgage paid off, a 30-year mortgage paid off 8 years early. Or you take out a 15-year amortized mortgage instead of a 30-year mortgage, and you bite the bullet and pay a higher mortgage payment, and you get your house paid off in 15 years. Yeah, there's smart and quick ways to get out of debt, but there's smarter and quicker ways to get out of debt, and I'm going to illustrate these. But a lot of people are shocked when I say the smartest and quickest way to get out of debt is not any way, shape, or form sending extra principal payments against the loan or the mortgage company, the mortgage, okay? And people say, what? I'll prove it to you. So let's talk about good debt versus bad debt. First of all, banks or credit unions, insurance companies, they view paying interest as a plus, not a minus. It's their friend, not their foe. If they stop paying interest, they would wither up and die. They borrow OPM, other people's money, and they pay 1%, 2%, 3% interest. Why do they do that? Are they just a benevolent institution? No. They pay 1%, 2%, 3% or more to you when they borrow your money, and they turn around and loan it back or invest it and make double that, okay? They pay you 3, they loan it out at 6 or 7. But normally they're making double, 100% more than they're paying. So it's actually an infinite rate of return because they're making 100% more than the cost of borrowing the money, but it's not even on their money. So you can't even calculate that it's 100% rate of return because it's not even on their money. So they call it an infinite rate of return. And so you can do this with your own money, which I've been doing for years, keeping my money compounding tax-free in my favorite financial instrument, a maximum funded indexed universal life insurance policy, where I have averaged 9%, let's say, 9.62 to be exact, tax-free. Now, some years I earn way more than that, 25%, 61%. Some years I don't make anything, but I don't lose because my money's not at risk in the market. But if I'm making 9% compound interest tax-free, every $1 million that is earning compound interest tax-free continues to grow and get bigger and bigger. Pretty soon I'm earning 9% on a bigger balance than I'm maybe paying interest on if I borrowed $1 million. And I borrowed $1 million, let's say at 4.5% tax deductible interest in a 33% bracket. It doesn't cost me 4.5% because I'm getting tax savings of 33% on the $45,000 of interest I'm paying on $1 million loan at 4.5%. So it only cost me $30,000 or 3%. And so I've often asked, well, how much more is 9% than 3%? Don't say 6, it's 3 times, it's 300% more. And that's why I say, would you hire an employee for 30 grand that made you an extra 90 grand? Would you buy a widget machine for 30,000 that made you an extra 90,000? That's a 300% return on employment cost or equipment cost. Business owners understand how money works. Well, this is why I borrow money out of my IUL policies, and I can borrow money at 3, 4, or 5% and continue to earn 25% like I did in 2017, and many of our clients did. They borrowed at 5% and left their money in the insurance company collateralizing that loan, and they got credited 25% that year. They made $250,000 in 2017, and it only cost them 5% or 50. They netted 20% tax-free on the $1 million that they borrowed out of their policy to go out. And I had a client that did this and bought a big apartment complex, fixed it up, and flipped it and made $3 million doing that while he was continuing to earn 20% tax-free on the $1 million that was left in his IUL policy, collateralizing the $1 million loan that he borrowed from the insurance company to do his real estate investing. See, savvy investors understand how money works. They don't use their money, they borrow OPM. Is this making sense? Okay. So let me go back to this getting out of debt. You need to understand the difference between preferred interest versus non-preferred interest. I'm going to simplify this. If you had a $72,000 income and you had $12,000 of non-preferred interest, meaning you can't deduct it, you're just paying interest on credit cards or a car or something, then you pay that and you only have a $60,000 left. You have zero preferred interest, so the available before tax is $60,000. Now, if that same person had $12,000 of preferred interest, they could deduct that interest off of their tax return because you could do that under Section 163 of the code because it's secured by a mortgage on your house or rental properties. You have the same $60,000, but what's the difference? You have a difference of taxable income of $12,000. This person who has non-preferred interest still has to pay tax on $72,000. The person who dropped the taxable income down to $60,000 only pays tax on $60,000. That's a $12,000 difference in taxable income in a 33% tax bracket. You're saving $4,000. Does that make sense? So that's preferred interest. So when you borrow money and you can deduct it, in a 33% bracket, it costs you actually less money, and that helps you earn a rate of return greater than the net cost of borrowing the money. Does that make sense? Okay. So I've often told people when you borrow to conserve, not to consume. Financial jellyfish, they borrow money for depreciating assets like a car. That's not smart. Smart people, they borrow to conserve. Conserve what? Their money. They keep their money liquid and safe, and many of them do that in the same vehicle I use. I call it a laser fund, which stands for liquid assets, safely earning returns. What's a laser fund? It's a property structured, maximum funded indexed universal life policy. So they keep their money there, compounding tax-free at 9% because they can borrow at 4.5% tax deductible, a net cost of 3, they're making 300% more by not using their money. And so that's why savvy, smart people, it would cost them money if they used their money. So they use OPM because they understand how money works and they are their own banker, so to speak. Okay, does that make sense? So years ago, people wanted me to talk about the difference between the good way to get out of debt, a better way, and the best way. Because I have a little ditty that goes good, better, best, never let it rest. Never let it rest till good gets better and better gets best. Okay? And so there were many companies out there that had software that would show you which credit cards to pay off first, the 18% interest one or the 12% interest one. Hello, this is not rocket science. But you would pay $700 or $800 for this software that would show you which credit cards to pay off first. And they would say, okay, once you pay off this credit card and this automobile loan, you take that money that you used to pay against that and don't go buy something else. You take that money that you used to pay to get out of that debt and you put it against your mortgage on your house. And they had software that would show you how to do this. Again, this isn't rocket science. And so they would show the average person reallocating the money when they paid off their credit cards and paid off their car, or maybe they would pay half of a mortgage payment every 2 weeks if they got paid biweekly. That's called a biweekly mortgage plan. Or maybe even convince you to take out a 15-year amortized mortgage and send extra principal payments whenever you could against your mortgage. So many times they would say, hey, look at this. You can have your mortgage paid off in 12 and a half years by sending this extra money that you're freeing up when you pay off this non-preferred debt. And you can pay off your mortgage in 12 and a half years. And then you sock away what you used to pay in mortgage payments in an IRA or 401k invested in the market. And if it does okay, it will grow to just about $1 million at the end of 30 years. You'll end up with $987,000. Sounds pretty good, right? Yeah, that's good. But then I would say, well, that's not the smartest way to go. Well, what's better? Well, this is what I do, because I learned that by having my money going into the property and that equity there, that if you get into trouble and you lose your job or your house goes down in value, they're going to foreclose on that property that has a lot of equity in it faster. And people who lose their income or get disabled, which is the number one cause of foreclosure, they go to those mortgage companies and they go, hey, I've been sending you extra principal payments. I estimate I'm way ahead. It doesn't matter. The next mortgage payment is due. And if you miss 3 mortgage payments, they'll foreclose on you, and they're going to foreclose on you sooner if you have a lot of equity. And if you have a lot of equity, not necessarily because your house went up in value, but because you paid all that extra money to the mortgage company, they're going to grab all that money. That's the deal. So what I do is I keep that money separated, but I understand how money works. I want it compounding over here in my laser fund portfolio. This is my right-hand pocket. That's my assets. It's compounding, tax-free at 9%. My mortgage is the net cost of 3. Hello? So by doing that, I have enough money in my laser fund, my IUL policies, to have enough money 2.5 years faster in 10.2 years. I have enough money in this pocket to totally pay off a 30-year mortgage faster than if I gave it to the mortgage company. But I'm in control because I have the money liquid and safe if I get into trouble. If I get into trouble and I've been sending it to the mortgage company, there's only one way to get that money back out of the house, and that's to borrow it back on their terms and prove there's a need why I should have it. So if you want to get out of debt a smarter way, I would accumulate it over in an IUL policy, and you'll have enough money about 2.5 years faster. You'll get out of debt faster. Now you sock away the difference, you'll end up with $1,245,000. That's another $250,000 than doing it the good way. That's why I say it's a better way. I'd rather have an extra $250,000 and be out of debt 2.5 years sooner. But that's not what I do. People go, what do you do? Okay, I do the best. I accumulate the money over here in my IUL policies to have enough money in 10.2 years that I could pay off the mortgage if I chose. Now I am out of debt because I define out of debt as having enough money in this pocket that any time with an electronic funds transfer or a phone call, I can take my money out of my IUL policies and pay off the mortgage. I am out of debt. These assets minus these liabilities, I'm out of debt. But I physically don't do that because why? I would be killing my partner, Uncle Sam, that's giving me a tax deduction, where I'm borrowing money at 3 and I'm earning 9. I would be giving up 300% rates of return. So I keep the mortgage. And by keeping the mortgage, I continue to earn 300%, 3 times more than the cost of the mortgage. And in my laser fund, instead of taking out a couple of $100,000 to pay it off physically, I end up with $1,844,000. $1,844,000. That's the best way to go. And then people get shocked when they go, that's not even what I do. What do? I do what thrivers do. I repeat the process. Every few years, every 5 years on the average, when my house goes up in value, I actually just refinance it until I hit age 62 or 65 and then do a reverse mortgage. I keep my property mortgage to the hilt like many wealthy people do. Why would I give up 300 to 500% rates of return? Because I've borrowed money sometimes at 3%, a net cost of 2%, and I've earned 10% in my IUL. By doing that, I end up with way more than 1.8 million. I end up with about 2.8 million. And that's just on a home that's worth $200,000 or a $200,000 mortgage. Hello? What if you are listening to this or watching this episode and you have a home worth $600,000? Well, we're talking about 4 million. What if you have a home worth $1 million and you have a mortgage of $800,000 and you do this? I'm talking about an extra $9 or $10 million over a 30-year period. Other than that, I don't have any strong feelings on this subject. This is how money works. And so that is the smartest way to get out of debt and continue to have your money working for you about 3 times greater than the net cost of the funds. And you will end up mega wealthy. So this is where you will pay in taxes about $96,000 in taxes on this, IRA 401k where you invest the difference. Golly, why would you do that? If you wait and then you pay off the mortgage and you invest the difference, you're going to pay $83,000 in tax. But when I put it in a laser fund, I never pay off the mortgage and I pay 0 in tax because this is tax-free. Which would you rather have? Okay, good, better, best. What about this? What's the difference? Doing it the good way, you end up $500,000 ahead after paying off a mortgage. Doing the better way, you end up with $735,000. Doing the best way, you end up with $1,242,000 net after covering the mortgage. I would rather have that. When you analyze the two, good, better, best, I would rather end up with $1,240,000 at the end of the day because I have $1.8 million minus the mortgage, but I was paying interest, which was actually helping me make 3 times the cost of the mortgage. Does that make sense? So this is how you can actually make interest work for you instead of against you. If you want to learn how to do this, I would love to gift you a copy of my most recent best-selling book called The Laser Fund. It's actually 2 books in one. This is about 200 pages, 14 chapters with all the charts and graphs if you're a left-brain learner. When you flip this over, this one is 100 pages, 12 chapters with 62 actual client stories that talk about these concepts. If you want to use both your right brain and left brain, you can read both, but here's how you claim your free copy. You don't have to pay $20 on Amazon. I'll gift you a copy. You claim your free copy by going to laserfund.com or click on the link below. contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I will pay for the book. I'll fire out a hard copy to you, priority mail. There's also options there to listen and learn, watch and learn. Check out some of our educational webinars that we teach on a regular basis at no charge. You can even schedule an appointment with no cost, no obligation with an IUL specialist who will help you understand how you can apply these concepts in your particular set of circumstances. But this is about you and your brighter future.